Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. The break in early October last year below the August to October ascending wedge pattern was a seminal moment here. 16 weeks ago, I laid out two avenues on what I thought might be the possibilities here. The market chose the first avenue and moved lower. I said at the time, and I quote, "The straightforward move down with potential targets for the ascending wedge pattern. Thus, a primary target X on the downside was already achieved in the 860 area, whilst the secondary harder to reach target X1 is way down below in the 712 area." End of quote. Since then, prices dropped below all the moving averages, and in early December last year, prices pushed below last August low at 743, what was then the lowest low and low close since late September 2021. As part of this process, we also saw prices move down in January below the March 2014 high at 724. However, that seemed to be enough at the time, as the March 2014 high is part of the congestion band 725 to 721, which also has the October 2013 low at 721 within it. I said 3 weeks ago when looking further down, and I quote, "Below this 725 to 721 zone, there appears to be no clear support until the January 2021 high at 693. End of quote. Prices then recovered somewhat in early February, but it was a very slow process, and the recovery has been limited. You see, overhead we have congestion created during July and August last year between about 780 to 843. Inside this congestion is a slowly declining medium moving average, currently 780, and a declining short medium moving average, which is pushed out of it, currently at 751. Then 5 weeks ago, I laid out two possible scenarios going forward, and I quote, "The primary focus is on what has developed from a bear channel into a descending expanding wedge pattern, highlighted in bright green on my daily chart, and originating from October last year. That's currently between 484 and 699. I carry on the quote. "The upper trend line here has had the added benefit of the short medium moving average entwined about it since late November last year. There is a further focus and one that may take up the running from this wedge pattern, and that is to look at the whole of May last year to date action as a possible large double bottom, Eve and Eve type action. But this idea has diminished since prices made a new low this week." End of quote. Well, my thoughts back then were that the descending expanding wedge pattern was the leader for lower markets, as it had at the time the short medium moving average entwined about that upper trend line. Then for a while it looked like, with the market moving above both the trend line and the descending wedge pattern and the short medium moving average, it looked as if these two were wrong and the market was going to recover and finally utilize that small double bottom that was not taken into account. But this did not take into account two key factors. And that happened within about a week of each other. The first was the bearish pressure put on the market by the declining medium moving average during the week of the 13th to 17th of February. This moving average capped the market and stopped the rise, and indeed any thoughts of a rise. The second factor was on Monday the 21st of February, the Monday after the capped rise, when the market made a combined daily key reversal down and bearish engulfing pattern. This was another seminal moment, because if you could place a point when this market started its current recent decline, then that would be it. It led to last month's monthly key reversal down and to a push below the following key supports that are now resistances. The October 2013 high at 721, the January 2021 high at 693, and most important of all, the 50% absolute Fibonacci line at 682. In the process of converting all these supports into resistances, the market reached the secondary harder to reach target X1 I previously mentioned in the 721 zone from the old ascending wedge pattern from last year. So where does that leave us now? Well, we have the broken and since repaired October 2022 to date descending expanding wedge pattern. But I am, to be honest, not happy about it. But it will leave it there for the moment until something better turns up. There's something better, could be a new construction actually, that originates back in early November last year and includes the failed small double bottom pattern within it. It is to look at that action as a possible bearish halfway hesitation. Now, if that is to be the case, and it is just actually showing at the moment as a potential pattern, then we could see a possible move down to target X in the 609 area, just around where the July 2021 low is. Just be aware of that gap from 2021, July 2021, between 657.5 and 659.5. Chicago corn. For many, many weeks here, this chart had been a headache for so many things going on. However, 3 weeks ago, it all seems to be settling into a pattern order. But first, before I deal with that, let's set out the key elements that are impacting this market. Firstly has been the impact of the long moving average from above, currently at 664. This has been a de facto bearish trend line. Then there's the July to October 2022 ascending wedge pattern. Now, I personally found this to be the most elegant of all the elements. In mid-October, the market exited, this October last year, the market exited this pattern for a primary target in the 648 zone and a secondary, much harder to reach target, X1 in the 550 zone. In his early December 2022, prices dropped down enough to reach the primary target, but hesitated throughout January and most of February before turning lower 2 weeks ago, specifically when reaching and punching through the lower tine, currently 683, which is highlighted in dark green, of the July to December 2022 bullish shift pitchfork. Now this segues nicely into something I wrote 3 weeks ago, or spoke about actually 3 weeks ago, and I quote, "I now come to the two key and recent elements of this market. The lower tine of the July to December 2022 bullish shift pitchfork, which I've highlighted in bright green, and the neckline currently at 693 of the November 2022 to January this year reverse head and shoulders pattern." Now you can look at these two elements on their own, but I would urge you to look at them combined into a new pattern, an ascending wedge pattern. The elegance of this pattern is sublime, especially as it is made from two other separate patterns. Currently the pressure is for a break lower as the long moving average is squishing the market lower. But I will not set out any targets for this pattern until one or other trend line is broken, but I can give you an idea of the size of the moves likely. Thus, for a confirmed break lower, it would have a primary move of about 13 cents lower and a harder to reach secondary move of 42 cents lower. That's the end of the quote. 2 weeks ago, we had that confirmed break lower. This gave a primary target below of 661 and a harder to reach secondary target of 632. The same week as the break lower, the market reached the primary target. And last week, prices reached the secondary target. Now, you may think, well, that was enough. But no. There's been further developments. 3 further developments, in fact. Firstly, and still undergoing finalization, is a possible dead cross of the short medium moving average, currently 664, down through the long moving average, currently also 664. This is a lagging indicator. Secondly, we have over the last 3 weeks formed a possible bear flag with a potential target X in the 590 zone. Thirdly, and finally, we have the market drop down to the next potential, if untested, support, and that's the lower time, currently 608, of the September 2021 to July 2022 bullish shift pitchfork, which is highlighted on my daily chart in purple. This pitchfork has never been tested on the downside, but the middle time above, currently at 748, managed to cap the market back in late September and October of last year. Hence, it does deserve some respect.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.